Good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at Options Play. And today we're going to be hosting our last session of our Options Foundation course, where we're going to teach how to trade vertical spreads. This is really the last piece of the Options Foundation course that allows you to take what you've learned, which are the foundations, and start applying them in a way that allows you to really take advantage of the benefits that options provide you with, which is the ability to take a directional view in the broader markets, but do so in a way with limited risk. You can do that by buying options. However, there are challenges with buying options and the cost of buying those options. You can collect income by selling options, but you have to take on a substantial amount of risk to do so. So today we're going to show you how you can use vertical spreads to kind of get the best of both worlds. So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we're going to show you during today's session as an educational example. But what we're going to go over here today is helping you, first of all, understand vertical spreads. If you're brand new to them, they're fairly actually straightforward to understand. They might be slightly intimidating at first if you've never traded one before, but I'm going to walk you through the two types of vertical spreads. There's a debit spread. We're going to show you what the strategy looks like, how to execute them, as well as how to manage them. Then we're going to talk about the second most popular vertical spread, which are credit spreads. We're also going to dive into them and show you how to manage these trades once you're in them. And then I want to talk a little bit about paper trading, how you can test out these strategies if you're brand new, and a little bit about position sizing so that you can understand how to size these appropriately for your portfolio before we end this for our Q&A at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you improve your probability of profit while limiting your risk when you're trading options. And the key word here is limiting risk. We all want to be able to profit, but we want to be able to know how to do so with limited risk. And that's really how you can help keep yourself out of trouble. And these vertical spreads allow you to go about doing so in a way that's more efficient than just either buying options or just selling options, because you're doing a combination of both. And during today's session, I will be going over the Options Play platform. And just a reminder for everyone who has access, this is a platform that's completely free of charge. So if you're brand new to Options Play, or if you have not signed up yet, you can do so at optionsplay.se, which I just posted the link into the chat window. If you have not signed up for this, we are going to go through this platform. And you should sign up for this because, again, it is completely free of charge and would allow you to follow along during today's session by signing up at optionsplay.se. So let's start by introducing, what are vertical spreads. Now, we're not going to dive into vertical spreads just yet. I want to talk about it from a conceptual perspective or academic perspective first, and give you a better understanding as to why we're even talking about vertical spreads. So what I'm going to start off with is just helping you understand that a vertical spread is simply just a limited risk strategy. So it's something that allows you to take a directional view on the market, but do so in a way with limited risk. And the key word here is limited risk. There are lots of different ways that you can utilize options. Some of them can be quite risky. Some of them can be used to mitigate risk. And this is really what vertical spreads are for. We're all trading options because we have a view in the markets and we want to express that view. We want to be able to profit from that view, but we also want to be able to control how much downside we have if the trade that we expect does not go in the direction that we expect it to. And that's really where vertical spreads come in. Now, they can really be suitable for either a mild or a large directional view. What do I mean by that? There are some stocks that you just think, okay, it's trending in one specific direction. It's either trending higher or trending lower. And that's really all the information that you have, right? You don't have much more of a view than it's trending higher or trending lower. That's what I would typically call a mild directional view. And then you have some stocks that you believe it's going to make a quick move fairly fast, fairly quickly, in a short amount of time. Now, that is typically due to a catalyst such as an earnings or a product release or some kind of macroeconomic event such as an economic release, something like that, where you believe that on the back of that news or on the back of that product launch, the stock can make a quick and fast move. If that's the case, then that's where you have a large directional view. So regardless of whether you have a mild directional view, a large directional view, a bullish or bearish outlook, there is a vertical spread that is suitable for that outlook. And the third most important part that's probably not on most investors' radar is that when you're trading a vertical spread, you can actually typically find better liquidity due to the limited risk nature of these strategies. Because keep in mind, a market maker who's on the other side of the trade, not only is it limited risk for you, it's also limited risk for them. And you tend to find that market makers, especially against retail flow, are actually more likely to be able to fill one of these trades at a more reasonable price because it does come with less risk, even for the market maker who's on the other side of these trades. So that's another thing to consider, that when you're trading these types of strategies, that when you're buying and selling vertical spreads, because they're a limited risk for you, they're also a limited risk for the market maker, that sometimes you can find better execution prices on this. Does that make sense to everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about the first vertical spread. Let's talk about debit vertical spreads. Now, when we talk about any of these types of complex strategies, whether we're talking about a vertical spread or a condor or diagonal, we have what's called a strategy driver, meaning for every complex strategy, there's always one component of the option strategy that is the primary driver of the strategy. And in a debit spread, that primary driver is going to be a long call or a long put. And this is something we discovered during our second session, which is the fact that when you buy a long call or put, you have unlimited upside with limited downside. But the trade-off that you have with this is that you have to overcome the cost of the option premium before you even make a profit. You actually have to believe that the stock is going to make a move beyond the break-even price in order to make sense for it to buy a call or a put option. Now, when you think about a long call or a put, this is suitable only for a large directional move, because you need the stock to move beyond the cost of the option premium before you turn a profit. So you have to believe the stock is going to make a fairly substantial move in order for it to make sense to buy a call option. So this is typically when you expect some kind of catalyst, like I said, earnings or economic event that could drive the stock price to move fairly quickly in a short amount of time. And the optimal environment for buying, a long call or put or a debit spread is when implied volatility is on the lower end, because the lower the implied volatility, the lower the cost of the call option that you have to purchase. The lower the cost of the call option, the smaller the break-even point, the smaller the move that it requires for you to be profitable. In a high volatility environment, the cost of this call option will be more expensive, which simply means that the stock has to move even more before it's profitable. That's why low volatility environments are better when you're buying a long call or a put or buying a vertical debit spread. So let's take a look at a real example of this. I'm going to use H&M. H&M recently had this really nice setup. It looks like a inverted head and shoulders pattern. It broke out above the neckline, came back to retest this neckline as support, and now is starting to trend a little higher. So really nice technical pattern here. Maybe you agree with this and you think that the stock can head back into this 130 level. It's currently trading around 120 crowns. Maybe you think it's going to head up to around 135 or so here to the upside, which were the highs back here in August and September. So what I'm looking at is going out to the January 2023 option, 2023 expiration date. And what I'm doing is I'm looking at the strategy driver, which is I'm buying the 117.5 crown call for 7.2 crowns. So this is where the stock's trading at 119, roughly 120 crowns. I'm going to buy a slightly in the money call option. This is the starting point. If you were just buying a call option, you would look at the January 2023 and you would look at maybe the 120 or the 117.5 call option. And in this particular case, the 117.5 will cost you 7.2 crowns. And again, that means the stock has to move beyond the break-even point, which would be 117.5 plus 7.2 crowns. That would be your break-even point if you were just buying the call option. Now, what we're doing here with the debit spread is not only are we buying a call option, we're also selling a call option against it. We're going to sell the 135s. We're going to collect 1.38 crowns for that. So instead of paying 7.2 crowns to buy this upside, we're now only paying 5.82 crowns because we're collecting $1.38 crowns. So what we're doing is we're reducing the net cost of buying that upside in this particular case by about 25%. We're saving almost 25% in premium. And what that means is that we're reducing our risk by 25%. We're reducing the amount that the stock has to move before the strategy is profitable by about 25%. And when you're able to reduce your capital outlay, your risk by 25%, what that also does is it has an interesting effect of magnifying your returns if you are correct. So what we're doing is we're reducing the risk from 720 crowns per contract now to 582 crowns per contract. And what we're doing now with that is that we do cap our max reward to 1,168 crowns, which is the difference between these two prices, 135 and 117.5, minus the 5.82 crowns. So the distance between these two minus the 582 gives you your total potential profit potential, 1,168 crowns. So that is the anatomy of a debit vertical spread. And it gives you, again, like I said, similar upside to buying a call option. What you don't have is the truly unlimited nature of a call option. But keep in mind, this has an expiration date. You probably do not think that the stock is going to reach 200 by January. So what you're doing is you're effectively paying for upside that you don't actually believe is going to materialize. So when you trade a vertical spread, what you're trading is a more realistic target price, in this particular case 135, between now and the January 2023 expiration date. And what you're doing is you're reducing your risk and reducing your costs and reducing the break-even price of an option, of this particular option strategy, by about 25%. And that trade-off is what gives you a better return if you are correct. It reduces your risk with the trade-off that it gives you limited upside. So that is the nature of a debit vertical spread. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about constructing a debit spread, because I did the construction for you, and now I want to show you how you can do it yourself, because the general expiration date for a vertical spread, a debit vertical spread, is usually about 60 days to expiration is a good starting point. And this is really because when you're buying an option, you are paying time decay, or time decay is working against you. And there are a few ways that you can try to reduce that amount of time decay. Trading a vertical spread in itself will reduce the time decay because you are also at the same time short an option. But by going a longer dated in time, you're going to be able to reduce the amount of time decay that you experience for each day that you hold on to the trade. It's going to cost you a little bit more than buying a shorter dated option, but for each day you hold on to that option, you're going to lose less to time decay. And that's the factor that you want to try to reduce as much as possible when you're buying an option. So going out 60 days is usually a good starting point in finding an expiration date that reduces that time decay per day. In terms of strike prices, this is where vertical spreads, you have 2 strike prices to consider. in a debit vertical spread, we always look at buying a slightly in the money option. So an option that's in the money by just a little bit. So we usually use about 50 to 60 delta as our starting point. And then we always sell an out of the money option. And we usually want to sell an option that's about, or a strike price that's about one standard deviation away from the current price for that expiration date. So what we're looking at is, what is the one standard deviation move for 60 days? And looking at roughly selling the strike price that's about one standard deviation away. So 15 to 20 delta. So only about a 15, 16% chance that the stock will be above or below that specific strike price on that expiration date. And we're purposely picking one standard deviation so that we have a nice balance between not capping our upside too much while still collecting enough premium to justify the reduction in risk and reduction in upside. So that's the blend of choosing expiration dates and strike prices. Now, before I move on, I just want to show you the options play platform, because the options play platform does all of this work for you. Now, you don't have to actually do the work manually. You can click on any symbol, and this is for any symbol for the Nordic markets. You can click on any symbol, and our platform will actually construct for you the vertical spread based on whether you're bullish on that specific stock, you're bearish on the specific stock. It actually does all of the work for you in terms of selecting, for example, the in the money option. So for example, if I'm bearish on Novo Nordisk, it's currently trading at 879 crowns. It's automatically going to select buying the 880 put, and then automatically selecting selling the 800 puts. And notice how the 800 puts is just around the one standard deviation mark. The one standard deviation is somewhere between 790 and 800 for that January 2023 expiration. So it automatically selects the strike price that is closest to the one standard deviation mark. Notice how it's a 0.17 delta, so 17 deltas. So it automatically selects the strike price suited for that, based on exact requirements or the exact specifications that I just spoke about. Our platform automatically picks that for you. And you can click on any symbol, Swedish match, for example. Very popular symbol at the moment. Now, sometimes we're not able to find a vertical spread. That's okay. That it's not always we're able to find a vertical spread. Sometimes we're not able to, but if we're not, we'll tell you that we were not able to find a vertical spread. Swedish match, the way that this stock is trading actually looks like it perhaps has been recently acquired, and maybe the strike prices aren't available. So let's take a look at another stock. Let's pull up our watch list here. I'll look at some of the banks. Let's look at Danske Bank. So let's say I'm bullish here on the Swedish banks here, which has recently had a very strong move here to the upside. And I believe, let's say I think this is going to continue moving on, but I think that I want to take that view I want to take that bullish view with limited risk. So this allows me to select that January 23, and I'm buying the 125 and I'm selling the 140 against it. So let's take a look at this. So buying the 125, I'm doing that because that's the first in the money option. As the stock's trading at 123, I'm buying the 125 call option, and I'm selling the 140 calls because that happens to also be about 17 deltas just inside of one standard deviation, or just outside of one standard deviation in this particular case, giving me the ability to basically purchase the call option for roughly 6.45 crowns, and then collect just a little over 1 crown by selling the 140 calls against it. And this platform automates this for bullish, bearish, debit spreads on any stock. You just type in the symbol, either select bullish and you'll see the bullish debit spread here on the right hand side, or you can select bearish and you'll see the bearish debit spread here on the right hand side. So regardless of whether you have a bullish or bearish view, you can instantly construct one of these debit spreads that are optimized for you both on expiration date as well as strike prices using the options play platform. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about managing these trades, because this is really where it does take some expertise or understanding to manage these. The holding periods of these is that you never want to hold them into expiration. And because when you're buying an option, time decay is working against you, time decay is not linear. It doesn't just decay by the same amount every single day. Time decay accelerates as you get closer and closer to expiration. So in the last 2 to 3 weeks is when you're actually going to see some of the highest amount of time decay. And that's why when you're buying a debit spread, you generally only want to hold them up till about 2 to 3 weeks before expiration. If, let's say, the stock has moved in the direction that you expected to, and now as you approach expiration, you think that it's going to continue moving higher, well, that's when you want to move your expiration perhaps from a January expiration. By the time that you get to the beginning of January, you might want to move it out to a March expiration. This way, you're going to buy yourself more time so that as the stock continues to move higher, you can continue to participate. But what you don't want to do is hold it through the end of that January expiration. And some of the rules that we have in place for managing a debit spread is you have two possible criterias to either cut your losses on a trade that's not working out or start taking profits. So the rule of thumb that we generally have is that if you've lost 50% of the premium that you've paid, it's time to cut your losses and move on to the next trade. And I'm going to go through an example of that. But if the trade is starting to move in the direction that you expect it to, and you've made somewhere between 75 to 100% of the premium that you've paid, then it's also time to take profits. So let's look at this example, and I'm going to use nice round numbers, right? So let's say I'm buying the call option. I'm buying a 100 crown call, and I'm paying 15 crowns. I'm buying a 100 crown call that I'm paying 15 crowns for. And then I'm selling a 120 crown call option for 5 crowns. So let's say my net debit is I'm paying 10 crowns for this vertical debit spread. If what I'm paying 10 crowns for increases to somewhere between 17.5 to 20 crowns, that's the 75 to 100% of the premium that I've paid, then it's time to start taking profits. Now, in the case that you're taking profits, you have a choice. You can take profits and continue to roll those profits into a new debit spread. Like I said before, sometimes a trade is going in your direction, and as it continues to move in your direction, you think that it can continue in that direction. So if you've taken profit on a debit spread, you can put on a new debit spread and effectively put on a new debit spread with the profits that you've made from the first one and continue to look for further upside. And when you've taken profits, it is an opportunity to potentially place another trade, okay? Now, let's say on the other hand, you pay 10 crowns for this debit spread, and the trade is starting to move in the opposite direction that you expected to. So something you paid 10 crowns for is now worth only 5, which means that you've lost 50% of the premium that you've paid on that debit spread. I generally tend to find that if that's the case, the trade is not moving in the direction that you expected to, it's time to cut your losses and move on to the next trade. And this is generally where I do not generally advocate for cutting losses and then trying to make your money back in the same symbol by trading a new debit spread. There are certain cases where it might warrant that, but the vast majority of cases, once you've cut your losses, think about moving on to the next trade. And this is really just about saving the other 50% of the premium that you've paid. Instead of trying to make your money back, to save that 55 crowns and apply that to the next trade that you can potentially make. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so let's take a look at our next vertical spread strategy, which are credit spreads. So a credit spread is the sort of, call it the opposite, or rather a mirror image of a debit spread, where the strategy driver, like we said before in the first example, each complex strategy has a main driver of the strategy. In this particular case, the strategy driver is a short call or put. And remember, a short call or put means that you have limited potential reward in exchange for substantial downside risk. But the trade-off that you make with that is that you'll be profitable even if the stock goes in the direction that you expect it to, you'll be profitable. If the stock doesn't move, you'll be profitable. Even if the stock moves a little bit against you, you'll still be profitable. Only if the stock makes a large move against you do you start to see some risk. And generally speaking, you really need a big move before you see what we call substantial risk. In a kind of even what we would consider an outsized move, many times the risk that you're taking is very similar to the potential reward that you can make in this type of strategy. So it's a very high probability of profit. That's why it's a very popular strategy. But again, the downside to this strategy is that you do have substantial risk. And this is a type of strategy that's generally best used for more of a mild directional move is expected. So this is when you think the stock is just trending in a general direction, you think it's going to drift higher or drift lower, you would either sell a short call or a short put. And this is generally better for a high implied volatility environment because what you can potentially make is the premium of what you sell the call or put for. So the higher the implied volatility environment, the more premium you're collecting, the higher the buffer that you have on this type of strategy before the strategy has some losses against you. The more premium you collect, the larger this buffer is going to be before you start to see losses in that strategy portfolio. So that's why when you're selling a credit spread, or that's why when you're selling a short call or a put, it's a strategy that we see a lot of professionals tend to trade more often because you have a much higher probability of profit. And we tend to find that a lot of retail traders stay away from the strategy because it technically has unlimited downside risk. But like I said, for you to have truly unlimited downside risk, the stock has to make a really large move against you. You have a much higher probability of making a profit than losing money on this specific trade, even though the losses that you can sustain is many times substantially larger than the potential profit that you can make. So with that in mind, the question for a lot of investors is, can I possibly have a strategy like this but not have the unlimited downside risk? Can I have a strategy where I have limited downside risk, but I still can capture this type of risk profile where if I'm right, I make money, the stock doesn't move, I make money, if I'm wrong on the direction, I can still make money? And the answer is yes, and that's where a debit spread comes into play. So I'm going to use the same H&M example. Let's say you don't necessarily know that H&M is going much higher, but you just see that it's starting to trend higher, it's starting to look a little better, and maybe you think this trend is going to continue moving higher. So what I can do here instead, before I was buying the 17.5 call, here what I'm going to do is sell the 17.5 put option. I'm going to collect 5.2 crowns. And remember, when I sell a put option, I have fairly substantial downside, meaning if the stock were to decline substantially, right? Let's say it returns back to below 100 crowns, which it was back here in October, right? Maybe markets get a little bit worse and the stock declines down to below 100. I want to make sure I protect myself. So what you do is, instead of just the 117.5 put, collecting the 5.2 crowns, I'm also going to buy a 110 crown put against that. I'm going to have to pay a little bit of money for that. I'm going to pay 2.7 crowns for that. So what I'm going to do is reduce the amount of premium that I collect from 5.2 crowns down to 2.5 crowns. So now my max reward is going to be 250 crowns. My max risk is going to be 500 crowns. So keep in mind that even though you're reducing your risk, the trade-off that you have with these types of strategies is still you're going to have negative risk to reward, which means that how much you can potentially make, 250 crowns, is always going to be less than how much you have to risk, in this particular case, 500 crowns. That's always the trade-off that you make with a high probability of profit strategy. This strategy is going to be profitable 57% of the time. So more than 50% of the time you'll be profitable. So the trade-off with a high probability of profit strategy is always going to be a negative risk to reward ratio, as you have here in a credit vertical spread. So let's take a look at how you construct a credit vertical spread. Now, because a credit vertical spread, your strategy driver is a short call and short put, time decay is actually working in your favor. That's generally speaking why we tend to favor slightly shorter dated expirations, 45 to 60 days to expiration. Now, sometimes with certain stocks, you just don't have expiration dates that are shorter than 60 days. So you use 60 days as your best proxy. But you do sometimes have, based on the timing of the month, based on if there are weekly options available, you might find that there are 45-day options. When you do have that option, choose the shorter dated option on this type of strategy. And what you're always going to do is you're going to sell an at-the-money option and buy back an out-of-the-money option. So we usually use about a 50 delta, an at-the-money option, and a 25 delta for the out-of-the-money option. So let's, before we move on, look at the platform again. I'm going to go back to H&M just to show you a consistent example. And when you're looking to sell a credit spread, and like I said before, credit spreads are strategies suitable for high implied volatility environments. So we're going to actually look at the high implied volatility strategy for H&M. And what you'll see here is you'll have both a bullish credit spread and a bearish credit spread that you can look at any time. I'm going to flip these to the mid price so that we can see them. And what you're going to see here is that for the bullish credit spread, now the markets have moved a little bit since I pulled these quotes earlier for the presentation. But as you can see right now, I'm selling the 117.5 and buying the 107.5 put vertical for if I'm bullish. And let's just take a look at that. So if I'm selling the 117.5, that's the first out of the money option. The stock's currently trading at 117.62. I'm selling the 117.50, the first out of the money option, and then I'm buying the 107.5 strike price, which, as you can see, is 24 deltas. That's the closest to the 25 delta that you typically want to use with a credit spread like this. And if we take a look at the bearish credit spread, right? Let's say, for example, you think that this is now going to start to trend lower here. Maybe you might want to trade the bearish credit spread. Here, I'm selling the 120 call option because that's the first out of the money call option. And I'm buying the 130 calls because, as you see, the 130s is the 24 delta, closest to the 25 delta. So our platform, just like debit spreads, will automatically construct debit spreads and credit spreads for you. Debit spreads are bullish or bearish strategies. Credit spreads are the high implied volatility strategies. And like I said, you have bullish, bearish, debit, and credit spreads that are instantly created for you using the options play platform. So hopefully, even if you feel that you're not confident in your ability to do this on your own after today's session, remember, that's why the platform is here for you, to help you do this work so that you don't have to necessarily construct these strategies manually. You can do them on your own. And if you're ready to execute these trades in your broker's platform, you can click on the trade button. And we have the short code that you can copy and paste into your Nordnet account, your Avanza account, and you can search for the options for these strategies using Nordnet, using the short code, and you will be able to find this exact expiration date and strike price to enter into your platform. So that's a little bit on kind of how to construct these. Let's talk a little bit about managing these trades. So with credit spreads, there are 3 rules for managing these. There's a stop loss rule, there's a take profit rule, and there is an exit rule based on time. So if any of these 3 triggers trigger at any time, it's time to get out of the trade, either at a profit, either at a loss, or simply getting out because you're getting too close to the expiration date. So the stop loss rule is if you've lost 100% of what you can potentially make on the trade, it's time to get out of the trade. The take profit rule is if you made 50% of the potential profit on the trade, it's time to take profits. And then the last rule is that if you've reached 21 days to expiration, and it has not reached either your take profit or your stop loss, it's also time to get out. And I'll explain that last part here in a second. So I'm going to use the same example. I'm going to sell a $100 call option. I sell a $120 call option. I collect 10 crowns. And then against that, I buy a $130 crown call option for 2 crowns, right? So let's say that this is a credit spread that I've put on. I've collected 10 crowns on the short leg. I paid 2 crowns on the long leg. So my net credit on the vertical spread here is 8 crowns. So when you sell something for 8 crowns, the most you can potentially make is 8 crowns, right? So that's why if the most I can make is 8 crowns, once I've made half of that, right, 4 crowns, then it's time to start taking profits. So that's why you typically put in your orders to buy back at 4 crowns. So you sell something at to 8. If it's now worth 4, you've made 50% of what you can potentially make on the trade. It's time to take profits and move on to the next trade. Now, if something you sold for 8 crowns is now trading for 16 crowns, that means you've lost 100% of what you can potentially make. Because 8 crowns is what you can potentially make. Something you sold for 8 is now trading at 16. You've lost 100% of the max gain on this particular trade. And remember, on a vertical spread like this, the distance between the 2 strikes, between the 100 and 120 crowns, that's your max loss, right? So you're cutting your losses before your max loss, because 8 crowns can go all the way up to 20, which would be a 12 crown loss. Here, you're cutting your losses at 8 crowns. And that's really kind of the key here, is making sure that you don't get to that max loss. Even though the max loss does protect you beyond that max loss, you generally find that it's best practice to cut losses before you hit that max loss number, because once you reach 100% of the max gain in terms of a loss, usually we tend to find that at that point, you're going to lose the other 4 crowns, and it's not worth continuing to lose the other 4 crowns. You're better off saving those 4 crowns and applying it to the next trade. Now, the last part is really important. If the trade gets to 21 days to expiration, and it has not triggered your take profit or your stop loss, it's also time to get out of the trade. And this has to do with the fact that your strategy driver is a short option. Whenever you're short an option, you have assignment risk, meaning the buyer of the option can exercise the call option or put option at any time, and you would have to deliver the stock or be short the stock if that exercise notice is assigned to you. Now, the risk of assignment is typically only higher in the last 2 to 3 weeks, especially if your call option or put option is in the money. But if it's outside of 2 to 3 weeks, your risk of that is pretty low. So when you're trading a credit spread, you generally don't want to be assigned early. So that's why when you're selling a credit spread, you generally have this rule of closing out a trade about 21 days to expiration. Now, if you think that the stock can continue to move in the direction that you expect it to, you can put on a new credit spread, but make sure you close the existing one at 3 weeks' time and sell a new 60-day or 40-day credit spread, because then you've moved the risk of early assignment out another 30 days or so. And it's really just about avoiding that assignment risk. And that's why we have the third rule for credit spread that you don't have with debit spreads, which is to avoid assignment risk. Because a debit spread, your strategy driver is a long option, and you don't have any assignment risk on a long option. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so last piece, let's talk a little bit about the portfolio tracking and paper trading. So we've recently launched paper trading on optionsplay.se, which means that if anything that you've learned here today, you need some more time. And especially if this is your first time learning this, I guarantee you're going to need more time before you're ready to execute these trades in your own portfolio. Click on any trade in Options Play. Whether you're looking at this call credit spread here on H&M, and you want to trade this, you can create paper trading portfolios. You can click on the trade button and select which portfolio you want to add this trade to, and simply add position. And when you do this, you have a portfolio tool in Options Play that helps you track these positions. And we created these portfolios to help you track your real-time portfolios. We created these to track your paper trading portfolios, and it's all designed to help you basically learn more about trading these options before you execute these trades in your portfolio. So let's say I'm looking at this Novo Nordisk trade before, right? And I'm bearish on this, and I'm looking at buying a debit spread, and I've never done a debit spread before. I can click on the trade button, put it in my paper trading portfolio, and I can add it to my position and see it in my portfolio. And when you click on your portfolio tool, you can even select the specific portfolio you added it to and view just your paper trading portfolio, for example, and see this Novo Nordisk 880 by 800 put vertical that I just put on and track the P&L of it, right? You can actually track this trade over the next 52 days between now and the expiration date until you actually execute, until you decide, okay, it's time to close out my position. You can close it out, click on trade, and it'll actually close the position from your portfolio. So you can do this by clicking on the position. You can not only track existing positions, you can also manage them. You can roll these positions, you can close these positions. So for example, if I close this position, I can add this position to my paper trading portfolio. It'll now disappear from my paper trading portfolio. So you can really treat this like a real portfolio that you're managing trades in. So whether you're testing out single leg strategies, multi-leg strategies, you can do whatever you want by placing these trades in your portfolio tool. And if you don't have portfolio, you can click on the manage tool, manage button, and you can create a new portfolio. You can create as many as you like. Like I said, I like to have a paper trading one. You can have multiple ones for your different live accounts, so that you can track not only your live portfolio, but also your paper trading portfolio all in one tool. So if you have, a Nordnet account and you have an Avanza account and you have a paper trading account, you can do it where you can track everything all at once using the OptionsPlay platform. And like I said, not only can you use this tool to add trades to your portfolio, you can also manage them. So if you have an existing position that you want to roll or you want to close, just click on the close button, add it to your portfolio, and it'll close those trades in your portfolio, making it much easier to manage. So hopefully that's helpful in giving you a better understanding. And lastly, I want to talk about the portfolio contract calculator. This is a really important tool. For a lot of investors who are new to these types of strategies, just learning the strategy itself is enough of a challenge. What I tend to find that a lot of investors do is that they don't have the tools to properly understand how many contracts they can execute. So this is why we created the risk and investment calculator. And in the risk and investment calculator, you will see a button here at the bottom that allows you to adjust your defaults. So I suggest that you click on your portfolio and adjust how much the size of your portfolio. Now, what our portfolio calculator will do is always calculate 2% of the total portfolio value you have. So let's say you have a portfolio of 500,000 crowns. Now, while you can adjust this number, 2%, I recommend that you never risk more than 2% of your total portfolio value on each options trade. So in this particular case, I have it saved to 2% of a hypothetical 500,000 crown portfolio. And when I save this as default, every time I place a trade, every time I'm looking at a trade, whether it's a debit spread or a spread, I can click on the risk and investment calculator and just click on the calculate button. And what it automatically does for me is it calculates the number of contracts that I can buy or sell of a specific debit or credit spread, and make sure that the max risk on that specific strategy is within the 10,000 crowns that I can risk on this particular trade. 10,000 is 2% of 500,000, right? So it's important for me to know that I don't have to do the calculations myself. I just have to, every single time I'm looking at a trade like this, I'm looking on the January 117, 132.5 call option. I click on calculate and it tells me I can buy 19 contracts of this. That means my max risk is 9,975 within the 2% of my total portfolio value. This is an extremely valuable tool to help you better understand not only what debit or credit spreads to trade, but how many contracts to trade to help avoid getting yourself into a position where you can potentially risk more than you wanted to handle on a specific trade. And 2% is a rule that we always use ourselves as traders, and we built the tool to help you instantly calculate this for any strategy that you're trading. And this works for more complex strategies as well. So if you're trading an iron condor, you can still click on the risk and investment calculator, and it'll tell you that you can buy 55 contracts of it, and your max risk will be 9,900 crowns. So you don't have to do any of the math yourself. It does all of the work for you and makes sure that the max risk of a strategy does not exceed what is your risk tolerance. And it's a really, really important tool for your trading and helping you stay in the right lane. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of the platform and how to utilize vertical spreads for your trading. Like I said, everything that I showed you here today is available for free on the Nordic Options Play platform, available at optionsplay.se, which you can see using the link here in the chat window that I just posted at optionsplay.se, or simply just go to that website, optionsplay.se, signing up for the full Options Play platform available to you completely free of charge. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in wrapping up the Options Foundation course for you and giving you kind of an ending to everything that you've learned, and how you can take everything you've learned and really apply it to something that's practical and something that's useful to you in being able to take a directional view in the market, in a stock, and in the markets, and do so in a way with limited risk, but at the same time being able to really reduce your risk while increasing your upside, or getting the same advantages as an option seller, but doing so in a way with limited risk. And these are some of the most important strategies that we use as option strategists, because it really gives you the best of both worlds. You learn about buying options, you learn about selling options. There are pros and cons to each one. And here, when you're using vertical spreads, you're really combining the two and getting kind of the best of both worlds. So hopefully this gives you and illuminates kind of what that means for you. Thank you so much for your time this afternoon. I hope that this was helpful. We'll send out both the recording and the slides after we finish here today. And with that, I want to thank you for your time. I hope you have a great trading day, and I'll see you guys here next time.